Welcome folks to episode 6 2024 ICT mentorship. So in this video I'm going to provide the same way I'm providing you the wizard version of ICT's 2024 mentorship. So welcome back and don't forget to give me the thumbs up. Don't forget to subscribe if you are new to my channel. Before starting this session, I would love to express my opinion about this episode. Over here, ICT actually focused on new things, that means learning concepts instead the mentorship continuing. Okay, that means last 6 episodes we have learned about the model, but in this video ICT has explained about something order block, why, when and how we should look for some kind of unfilled fair value gap, then how we should think just above before the news days, something like that. Okay, not the same thing we are learning until the episode 6 about the 2024 mentorship. So this is gonna be a learning session, not the model session. Let's go to the video. Over here, this is the low. So this week low, this is a weekly candle, obviously, weekly chart. This candle low, then body has traded until that area, and week reached until that area. So from here to here, this whole area is balanced. So when market was over there, ICT's first expectation was market can reach until that level, so that low, exactly to that level market can reach until that area. Then market went through this area, that is different matter, we'll talk about that later. But right now you will remember this is that line from weekly chart, that candle low, so just below that balanced price range. Let's go to 1 minute chart. I would love to spend most of my time from my 1 minute chart, as ICT has done that. Okay, so this is that line. If you don't forget, the weekly week low, that means balanced price range low, that is that line. Now over here, this is that 8:30 news candle. We had a news around 8:30, that is the PPI news. When you have some kind of news like PPI and the CPI, tomorrow is the CPI, so this is just before CPI. In this type of time, when you have a big number is coming, you should not look for the 7 a.m. relatively equal highs or relatively equal lows. You don't need to look for those, and you should not look for those. Okay, you have to wait until 9:30 open. So this is the opening bell around 9:30, as you can see. After that, you will start to look for relatively equal highs and relatively equal lows. Before that, you can see market actually came until that line. See this line, this is the new day opening gap. So this is the new day opening gap. It has created Monday evening. This is that new day opening gap. Market tapped to that new day opening gap perfectly, left that imbalance over there, that means inefficiency over there. So primarily my expectation was, or the ICT's expectation was, market can reach until that line, then it will fall until this new opening gap. Here I would love to tell something or add something. As per ICT told, if you are looking for something that you are waiting to happen or waiting to see from the chart, and you don't get that, don't participate in that price action. So when market is going higher and you are looking for sell, why? Because market should reach to that new day opening gap, and also there are some relatively equal lows. I will talk about that later, just after some time. Okay, I will talk about them as well. So when market left that sell side liquidity and it is keep going higher, ICT is not going to be sad to miss all of that move. This is what you should think as well. When you are seeing that market is already over here and it is going higher, it is keep going higher, don't participate in that run, because in that type of situation you are actually chasing the price. Don't chase the price, instead wait for something that is more obvious, and you should wait for sell side liquidity as market is going higher. If it doesn't do that, ICT doesn't like this type of days, and he avoid trading in those type of days. So he doesn't give a shit when markets keep going higher. The same way I talk to you guys. Okay, that is the thing I wanted to express. So let's go what happened around 9:30. Let's see. So this is 9:30 candle. Market has opened over there, then it went higher, then made that high. Okay, so when this is the high, which high has taken this London high, this is the relatively equal highs. So this high and that high, they are relatively equal highs. At the same time, all of these relatively equal highs has been taken. This is the initially minor liquidity or initial buy side liquidity. So when market has made that buy side liquidity, then relatively equal highs, this high and that high, they are relatively equal highs. Market has taken that relatively equal highs. You will start to mark your sell side liquidity. Where is your relatively equal lows? And as you can see, this low and that low, they are relatively equal lows, a very clean lows. Okay, this is a very clean lows. So you should think that after taking this buy side liquidity, market will go for that sell side liquidity. That should be your intention, and market should do that. If it doesn't do that, that means you are not going to participate in that price action. So when market came here, tapped to this fair value gap. So over here I have a very little fair value gap. Let me mark it. So this is the fair value gap where market has traded. After trading that fair value gap, market went higher, take that high. Okay, that swing high which has taken all of these relatively equal highs, also the London high, everything has taken over there, tap to this weekly low, that means imbalance low. This is the perfect area where market should reverse. What market can go, what market can do more, it can go back again until that high, to take that high, so that all the people who are thinking the same, that market can fall, market can reverse, they will be stopped out over here. So market has taken that high one more time. Let me just mark that on. Then after taking this high, this is the fair value gap that you should keep in your mind, that market is not going to, just let me change the color. Market is not going to respect that fair value gap. It will go through this fair value gap. It will tap to this fair value gap. It will use this fair value gap as a resistance. Then market will fall. Where? To that relatively equal lows, a very clean lows. Maybe then this low, and finally this relatively equal lows over there. So this is also the relatively equal lows or very clean lows over there. So market, you will think like that way from that specific fair value gap. But what happened? Market tapped to this fair value gap, closed at the constant encroachment of that fair value gap, perfectly went higher to that high as well. Okay, after taking this high, market was just consolidating. Okay, after taking this one, market was consolidating, and I would love to keep it over there. Look, market never closed below this fair value gap or even the constant encroachment of that specific fair value gap. Market didn't want to fall. So when it is not willing to fall, you should not think that market is going to take that sell side liquidity, and you should not participate in that buy run as well. At the same time, when you saw that market is actually not falling, so over here, this is the perfect place for fall even after this big move. When you saw this big move and you were thinking that market is going to fall for this sell side liquidity, but market didn't fall. Instead, it has taken this all the relatively equal lows. Look at this, all relatively equal lows. Market has taken that relatively equal lows. What does it mean? Now I'm going to remove this fair value gap for a little, and I would love to mark all of these relatively equal lows. Look, all of this relatively equal lows has been taken over there, and market didn't fall, respected that bullish fair value gap again. Not even a single body has closed below this constant encroachment of that fair value gap. Then it started to go high. When it has started to go high, you should start to look for buy. Where should you look for your buy? Now here is the part or the time where, when, let me rephrase it. This is the place where you should look for time first, then the price. What do I mean by that? Let me mark the macro. The macro is actually from 1050. Just let me mark 1050 to 1110. So this is the macro time. Market is going inside the macro time, and also it is going for taking that buy side liquidity. This single high, it is going to take that buy side liquidity. Why? Because market has taken this relatively equal highs, make that initial buy side liquidity again, and it went lower, jacked that sell side liquidity. So it is reaching for that buy side liquidity. At the same time, this relatively equal highs over here, this is the relatively equal highs. Market is reaching for that macro. I will explain this macro, and at the same time, when you should expect that some fair value gap will be unfilled. Why it is going to be unfilled around that area, I will explain that as well. So when market went little higher, after reaching over there, market fall again, trade that fair value gap. Look at this fair value gap. After trading this fair value gap, let me mark it, this fair value gap over there. This is a fair value gap over there, and after trading this fair value gap over there, it's a very small fair value gap. Look at this candle. this specific candle has closed above the opening of that bearish candle. This is your bullish order block. Why that is your bullish order block? Because market has taken this sell side liquidity. It doesn't need to go back again, and it went higher, tapped to some kind of bullish fair value gap. This specific down close body close candle, when market has closed above this down close candle, closed over there, come back again. Where did it came? To that specific candle, mark the 50% of that candle, that is your main threshold, tapped over there, boom, market went higher. Where did it go? To this relatively equal highs, then this high. Above this high, this is the volume balance from daily chart. If you go to your daily chart, you will see there is a volume balance. So market is actually reaching for that volume balance. Now here is the part when you have got that bull run. Look at this bull run, big run, and it didn't reach until this volume balance. So this volume balance is the most, or sorry, the low hanging fruit. You are thinking that market is reaching for that low hanging fruit. Reaching over there, there was a fair value gap, another fair value gap over here. So this is the fair value gap. You should expect this is going to be unfilled. That market is not going to fill this fair value gap. How do I know that market is not going to fill this fair value gap? This is the part is for learning. Okay, so I am going to explain this one. Look, after 8:30, sorry, after 9:30 open, market went higher, trade that fair value gap, went higher again, make this fair value gap. This fair value gap was holding the price. Okay, after that, after seeing this, all of this price action was the consolidation. So let me mark the consolidation area, this high to that low. This is the consolidation area. Okay, so over here, let me mark it. This is the consolidation area. So market was consolidating around that area, specifically all of this area. Market was consolidating. After all of this consolidation, market has taken that low. That consolidation low has been taken by that specific week. Then market left that consolidation area with speed. Look at the speed. Okay, so this is the speed. All of this consolidation area is actually the balanced price range. This is the balanced price range. Market doesn't need to reach until this balanced area. So above this consolidation range, you have this imbalance. Look at this imbalance. You have another imbalance over here. Are you going to think about this imbalance? No. Why? Because this is the balanced price range and this is the consolidation area. Market has taken this consolidation already. The low of the consolidation has taken over there. Market went through this balanced, that consolidation area made this imbalance where market is reaching for. Now let me put it over there. Look at that high. Market is going to take that high, then this volume balance, the low hanging fruit from daily uh, what to say, I mean, sorry, daily chart. Okay, so what happened? Market came here, tapped to this fair value gap, where you should think that market can reach extreme way the 50% of that of that fair value gap. Market can reach until the 50% of that fair value gap, then it will go higher. Most of the time it will tap to the high of this specific fair value gap, and then it will go higher. It will go higher. Before going higher, there is your order block. Now where is your exact order block? When market tapped over here to this volume balance, this fair value gap, then exactly from where it tapped before that volume balance, before trading that volume balance, market came here and then went higher, come back again by 1, 2, 3. It takes 3 candles to reach to this volume, that fair value gap. Let me mark the opening of that consecutive order block. So this is going to be your consecutive order block. I'm just mark the open because this is the place where algorithm look into. It doesn't care about this week. It doesn't care about that one. So what you will do, you will mark the open, this candle when it has closed above that candle, and then price come back again where? To this order block, exactly where it went. Mark the 50% from where to where? Body to body. This is the place where algorithm are watching. Okay, so this is the mean threshold of that consecutive order block. And if I just mark the consecutive order block mean threshold, this is the 50% of that consecutive order block. Which did the damage? Look at the bodies. Is there even a single body which has closed below this mean threshold? No. That means market actually referring, or the algorithm is referring the upper portion of that consecutive order block for to be traded and then went higher. Here is the part which you are going to learn from this specific episode, and that is the macro time. Every single hour has the macro. So if it is 11, then the macro time is going to be 10:50 to 11:10. If it is 10, then the macro time is going to be 9:50 to 11:10. If it is 12, then the macro time is going to be 11:50 to 12:10. Okay. So this is that closing of the macro and the opening of the macro. I just removed it. Remember one thing. When market is inside the macro, it will do three things, but not all together. What is that three things? Either it will trade the inefficiency, or it will trade the order block, or it will take the liquidity. But you are not going to get all the three all together. Okay. Most of the time you will get either two or maybe one. Two or one. That means not the inefficiency trade, then order block, and the what to say, I mean the liquidity taken. No, it's not going to happen. You are going to get just two out of three. Maximum time you will get one. That means maybe it will trade that inefficiency when market will go inside the macro time. It will trade the inefficiency. Maybe you will be able to frame the order block, but you are not going to see that market is going to take the liquidity. It's not going to happen. Or maybe market will take the liquidity and it will trade some kind of order block, then it will go higher. Or maybe after taking the liquidity, it will expand higher. Okay, so you are going to get just one or two out of three, not all together. And at the same time, look all of this macro time. What happened? This is the order block. Then market come back again. Where did it came exactly? To that specific order block level. See? And this is the 11:10, just 11:10 candle, not 11:11 candle, not 11:12 candle, just 11:10 candle. Come back again. Where? To that opening price of that order block. Why that is the order block? This is the change in state of delivery, because when market has traded that inefficiency, it should go higher. Where? To take this buy side liquidity that high. It should take that high, and then finally it should reach to that imbalance. But no, it didn't do that. After trading this inefficiency, market went higher, started to fall, right? This is the down close candle or the opposite candle. It is opposite candle which came back again to tap to this inefficiency, then started to go higher again. So this opening and the 50%, they are the important part where market is going to trade it one more time before expanding higher. This is your order block and the mean threshold. Market came here perfectly, then tap to this order block one more time, went higher, trade the high of this volume imbalance. Actually, let me show you the volume balance. It will be easier for you and for me to see that volume balance what I was talking about. Okay, so here look, this is the volume balance. This candle low, this candle, oh sorry, this candle open, and this candle close. This is the volume balance I'm talking about. Okay, oh, actually not like that. My set was open. My mistake, sorry. That is not the volume balance. Here this is the volume balance, and because of my set was open here, that's why the volume balance was little bigger. So this is the volume balance. You should keep looking here. This is the volume balance. So let me go to 1 minute chart one more time and remove this one and keep the volume balance over here. So that is the volume balance what I was talking about. Then market has traded the volume balance high perfectly. Market is going higher. Now look at this price action. Are you going to participate in that price action? If you want, as ICT told, you always try to use everything ICT has taught us. Okay, don't focus on everything, because if you try to implement all of your learning or all of your knowledge in this chart, you will be chopped up. You are not going to learn everything, or you are not going to apply everything in one single chart. Try to be master of one concept. It can be the fair value gap concept, it can be the order block concept, maybe the breaker block concept, anything you want, but be the master of one concept, and then try to be the master, I mean try to use this concept until you are not fully confident about that trade. Okay, then market went higher, come back again to this volume balance, refer that volume balance for the more higher run, and it went higher. If you look at 11:50 to 12:10 macro, just let me show you this, as my ICT has showed you that what I have explained over there to that specific macro, I'm going to show you that same thing over here as well. So here until 12 10. This is the macro. Okay, now this is the first time when market came into this macro. Now let me show you 11:50 to 10 12 10 macro. What happened over there? Was there any inefficiency? Every candle is overlapped by another candle wick or by the body. Okay, so what you should look for over here, market when it is reaching lower, it didn't trade any inefficiency. So what you should look for, that market will go and take the liquidity. Then market went higher again. Was there any inefficiency? No. Market went higher, take that liquidity. Okay, here is the liquidity taken game is running. The liquidity taken game. After taking this liquidity, boom, market went lower. Take that short-term low or the liquidity reached until that volume balance. Now maybe you are looking for buy, you are not looking for sell, instead you are looking for buy. So what you will see, it has taken this low, look at this low, it has taken that low, a specific low. After taking that specific low and traded that volume balance, market went higher. Now here, as you can see that there is no inefficiency trading. So here is the liquidity taken is going on. Okay, the liquidity taken is going on over here. It has taken that liquidity, then market went higher. Look at this candle. Okay, open, just mark that open. Now ICT didn't show it to you, but this is my understanding, so I'm just adding this over here. So this is the order block because this candle has closed above this open. Then market come back again. What did it came back? Exactly to that opening range. So market is reminding this opening when just inside that macro. Look, this is the ending of this macro. So you are going to get two things over here. It has taken the liquidity, then it has traded the order block. You take that buy until that high. When this high is taken over there, you are done. This kind of bread and butter type setup, you are not going to get a 200 or 500 handle, something like that. Instead, it's gonna be very small and confident entry. If you know what you are doing, this is going to be your trade. Okay. At the same time, when if you see over there to that fall, market has taken that buy side liquidity, market fall, trade where to that imbalance, then boom. Did you see the order block entry over there? No, there is no order block entry. So here liquidity taken and the inefficiency was implemented over there. Here liquidity taken and the order block was implemented over there. No inefficiency here, no order block there. Same thing over here, there was just inefficiency and the order block. Look, market didn't take the liquidity. See, this low is not taken by that low. It's not the liquidity taken. Even this low didn't take by that low. It's not the liquidity taken session. So over here, this macro was inefficiency and the order block. So I hope that you got some information over here that is insightful for you. I would love to complete my session for today because this was the learning session, not related with the 2024 model, because I didn't listen anything ICT was talking according to the model. But it is also important because you have to know if you have a big number is coming like CPI, what you should think at that time. Okay, now you are not going to take that buy or not even that buy. You are not going to take any of them because market is going higher and that is against your bias, or maybe you are going to chase the price. You are not going to participate in that, but you are reading the price to build the confidence. Okay, you have to do that, but that doesn't mean you have to push your button. No, you are doing the journal. Make your chart is like that way. Write it down over there what you have learned over here by that by seeing the or reading the price action over there. Please write it down, take the screenshot, keep that for your journal. It is going to help you for the longer term. Okay, so this was all for the for this session. Just make sure that if you have a big news is coming just in front of you, you are not going to rush in that market. Instead, you are just waiting for a better price action so that you can be profitable in a longer term. Okay, so that was all for this video. I hope that it is insightful for you guys. If it is insightful for you, don't forget to give me the thumbs up. Don't forget to subscribe to my channel if you are new, and don't forget to let me know if you have any doubt to the comment box. So until the next video, cheers.